Hi guys, this is Kelvin here from Round and Search. So today we're going to talk about quantitative easing and interest rate decision. How does it affect the stock market? So before we start, don't forget to like us in our Facebook page and subscribe to our YouTube channel. And for those of you who want to open a trading account, you can look at the link in our description to find out more about the account opening. And for those of you who are interested in our operator analysis course, to find out more about how to analyze the big boys transaction data, we are having this training course here. So if you want to know more, you can click at the link in the description as well. So I believe a lot of people in the market, traders and investors, you have read the news about the Federal Reserve in the US, which is the central bank of the US, is going through might taper into the quantitative easing, which is the QE, and also there might be an interest rate hike in the near future. And this actually have a huge effect in the stock market that causing the market down. So today in the video, we're going to talk about quantitative easing and interest rate. How does it affect the stock market? So these two monetary policy is actually a different two. So don't mix these two together. So it doesn't mean that they have a QE and then it will affect the interest rate, but they will actually manage it both together. So let's take a look into the first thing, quantitative easing. Quantitative easing, which we call it QE in short, and also known as printing money. So the central bank usually prints the money and also use the money to actually buy long-term bonds or long-term financial assets from the market to create more liquidity into the market. So this will actually help them to actually inject the money into the market indirectly into financial institutions. Now, when I mention financial institution, it can be investment banks, funds, and all other institutional investors. So QE is mainly focusing on this group of people, or maybe some banks as well. So interest rate decision. So this is actually used to mainly targeting those banks or commercial banks in the market. So why increase of interest rate will actually affect the stock market is because those banks usually they have a fund reserve with the central bank. So when these funds are reserved, are deposited into the central bank will pay them some interest. If let's say the interest is higher, then they will prefer to have the funds to place with the central bank. If let's say it's lesser, then they will prefer to have the funds to lend it out or giving out loans to the market. So this will actually create more liquidity into market. That's why you see whenever there's a financial crisis or the market crisis, recession, the interest rate will be lower. So this will actually indirectly affect the market to allow the banks to actually lend out more money to the market. So right now I see the two different policies from here, QE and also interest rate. So from what we see at the current moment, at the current event, we see that they are tapering on the QE, which they will be reducing bond buying decision or maybe some of the long-term asset in the market, which means lesser liquidity in the market. And also they are increasing the interest rate. So if let's say if it's increasing the interest rate, that means that there are more funds are reserved or deposit into the central bank. So lower loan will be lent out. So this is the decision that from the central banks. So this actually affect the stock market in a way because it's lower liquidity in the market, so which means that there are not much fund in the market to actually support the price at the high level. That's why you see a lot of institutional fund or investor, they start to take profit once the decision is announced, or maybe before that they already start to do some profit taking. And how come the interest rate increase will affect the market to fall? Of course, this is generally not always happen. So sometimes interest rate increase, the stock market will still continue to move up higher. This is mainly on the expectation of the investor, because the financial market is based on the expectation of the investor, financial institution, or maybe you can call it the big boys, the hot money. So this hot money expect that the interest rate increase will actually increase the cost of the listed company, which will affect their performance in the next quarter or maybe next year profit. So this is why they start to take profit from the stock market and move the funds into another assets. So this is the reason why a lot of stocks around the world are affected with this announcement from the central bank. So this is the layman explanation towards why QE and also interest rate will affect the stock market. Of course, based on the historical event, not always having the interest rate increase and then the stock market will fall, or maybe tapering on the QE, the stock market will fall. Sometimes they will have some correction from there and then start to move about higher again. The reason is because the whole world of this financial market, all these big boys are based on expectation. If let's say they expect somewhere that is not profit making, then they start to move their money into some other assets or some other investment to generate a better return, or maybe during the time that is bad to protect their profit. So this is the truth of the market. So everything is based on expectation. If let's say you want to understand more about the market, then look into the expectation of the institutional investor or the big boys will definitely help you understand much better. QE is not something new that is used in the market in just recent years. It has started using it during the Great Recession time. So during that time, the Federal Reserve or maybe the central bank start using this way, printing money to actually buy long-term government bonds from financial institutions. And then slowly, when it comes to 2008 time where the mortgage crisis came in, they started to buy longer term for the mortgage loan. So based on that, they are using this to actually affect the long-term expectation of the investor and also for the market to actually help to balance out the market, because during that time the interest rate was very close to zero. So when it's close to zero, the interest rate effect, it doesn't actually have much effect into the market. So that's why they came out with the QE together with interest rate adjustment. So it helps to balance the market, to help to boost, and with interest rate as a tool to actually adjust the market to the balance point. And because there's so much of this fund printed out and pumped into the market, into the financial institution instead of into the banks, that's why we see a lot of all this venture capital and also all this investment coming in to the market. In the past, we don't see this much of VC, and also maybe you can call it the crowdfunding actually comes in. The reason is because long time ago, we are still using a lot based on interest rate decision to actually help the economy to boost up, or maybe to soften the economy to avoid any inflation rate that is gone too high. So that's why we see the market is starting to change a bit. Maybe it's not so rely on borrowings for some of the companies. Some are prefer to actually have a balance out, to have more equity share out to these VCs, or maybe some of the, we call it the crowdfunding company, or maybe some of the institutional investors. That's all for our sharing here. So I hope every one of you are able to understand a bit more about quantitative easing and also interest rate hike, or maybe the decision, how it affects the stock market. So if let's say you have any topics you wish us to cover it, don't forget to leave it in the comment, and we try our best to make a video for everyone from there. See you guys next time.